Welcome to the Times of Industry show. As we're recording this interview, a number of important themes are playing out, which our guest today, Gregory Mannarino, founder of the traderschoice.net, and a great one-on-one YouTube blogger. He will be sharing his opinions with us today. Gregory, how's life?
Life is good. Every day above ground is a good day, and that's how I try to look at the whole picture.
Hey, let's start with gold. What the heck? What's going on?
Well, let's see. I almost don't know where to begin with gold, precious metals across the spectrum here. It seems that no matter what happens with the dollar, they find ways here to pressure precious metals here. I don't believe they want people in precious metals. I also don't believe they want people in cryptocurrencies. I do own all of these assets. It seems to me the powers that be, the world central banks, the Wall Street banks, they have their agenda. Their agenda is very simple. Their agenda is to keep people in the dollar or in a currency they can control. And that could be euros, that could be any central bank issued note. Things that are out of their control, they will do everything in their power, in my opinion, to keep people to keep people confused, unsure of what they should be doing. Because what's this whole thing really all about? It's about control. It's about having the ability to manipulate people into whatever behavior will keep people in, spending, borrowing to spend. In other words, keeping them in units of debt. They don't want people to think down the line a little bit that everything may be a little distorted right now, that perhaps they should be looking in other spots of the market. We know the markets run in cycles. I mean, this is no secret, unless people just are new to the markets. We have booms and we have busts. Right now we're in some kind of a boom. I think it's engineered, a lot of it, most of it because of central bank action since the meltdown of 2008. I think in fact, I know there's going to be a lot of distortions across the spectrum of asset classes distortions across the spectrum of asset classes, which are going to correct to fair value at one point. This includes gold and silver. And we're just going to have to watch this all play out. It's kind of interesting.
Now, with regards to how to build a gold or silver or precious metal position, knowing everything that you know, what is the best strategy, or what is your personal strategy with regards to precious metals?
Physical hard assets. I don't even touch the paper ETF markets. They're just so twisted. They have no bearing on reality. There's no price discovery mechanism behind it whatsoever. So what I've been doing for many, many years is acquiring the hard assets, gold, silver. I also own platinum. I own palladium as well. Silver is my favorite. And again, these are not trades. I'm holding the asset. So I'm thinking down the line because, again, we are in some kind of an engineered boom cycle for which some major banks are warning about right now. We spoke about this in the pre-interview. And I think that, down the line, these are going to achieve their true value over time. So, people can look at this however they want to, but I think you need to look at this market from several different perspectives. You have to have a short-term perspective on how things are going to go, and a longer term, which is probably more important than anything else. So for me, it's pretty simple. I trade these markets. Everybody knows that. I tend to pull profits out of these and then convert those profits into hard assets. I think that's the way to play this. Right now, the market is the gift that keeps on giving. I've been explaining this to people for a very long time. It's not real. Take advantage of that. They're suppressing interest rates into oblivion. They will continue to do so until they can't. But the market will achieve a fair value at one point. So we'll see how that plays out. But again, down the line, longer term, in my opinion, and this is just me, I think suppressed assets is where you need to be.
Interesting. I'd love to hear more about your position size in gold and silver versus your other portfolio and more advanced stuff. But I'd like to also get your opinion on other topics. So let's move on. Keep those more specific questions for later on in the interview. And I couldn't agree more with regards to the yields with 4% GDP print and with 2.9% CPI print. The 10-year bond should be around 6.9% today, and it's not even half that. They are suppressing.
That is, just hold that thought, what you just said, because that is very profound, and people don't have an understanding of that. People just don't even think about what you just said, but it is absolutely true. So, I mean, how could anyone who has an understanding of that, and obviously you're one of those people that do, thank God, think that the environment we are in is real or sustainable? It's just not. Something has to give, and it's going to. But that's an amazing point that you just brought up. I want people to think about that.
Now, Gregory, how do you gauge the stocks bull market? When do you see it topping? What kind of metrics do you use to understand if the S&P 500, the Nasdaq, the Dow are currently uptrending, downtrending? Are we correcting, or is this topping off? Where do you see us overall with regards to this, and where will investment dollars go once these three indices that have trillions of dollars worth of pension funds, institutional money, our money in them? Where will investment dollars go if this goes into a bear market or a sideways market?
Well, the easiest gauge for me, and this is something I look at every single day, I look at the bond market first. People look in the wrong spot all the time. They're looking at what the major stock market indices do. And to me, I just don't get that. And I've been telling people this for years and years and years and years. And I think at least I would like to hope that some people are coming around to it. But to put a perspective on it, what we need to be looking at, the number one place is the bond market. The bond market is the biggest market of them all, the debt market, period, the end. There's no disputing that. So knowing that and realizing that world central banks, all of them, but let's stick with the Federal Reserve, I guess, here, because this is where I live here in the United States, has gone through unprecedented, and I'm not making this up, we've never been here before. This is like Star Trek, where no man or woman has gone before. Efforts to keep interest rates suppressed has deliberately created an environment of risk. There's nowhere else to go. So with this, they've inflated a stock market bubble. And so what I like to look at, the number one thing I like to look at is the 10-year yield. I call where we are right now the sweet spot. The sweet spot is below 3%, depending on where the dollar is trading at any particular time. But let's just say it's below 3% to make it simple for everyone. As long as they're keeping the 10-year yield more or less in that sweet spot, stocks will trend higher or sideways. If we end up moving over that, we will see pressure build on stocks. It's the only thing that has kept this market going is the artificial suppression of interest rates for now an entire decade. Now we got people like Jamie Dimon coming out over the last 2 days warning that there's a problem here. Jamie Dimon being the CEO of JP Morgan Chase. Everyone knows that too. He's saying, hey, you know what? There's a problem here with the QE unwinding. The Fed, in other words, what he's trying to say is the Fed, quote unquote, normalizing their abnormal balance sheets. Insane. So that's a problem looking forward. But understanding these very basic dynamics and just understanding that if they can keep the 10-year yield in that sweet spot, stocks are going to trend in one of two ways, either higher or flat, more than likely higher, because there's nowhere else to go. that's what people should be doing, looking to get long the market. And I've been, look, I hate to sound like a perma bull, and I've been that way now since the election of Donald Trump. And I came out publicly stating when he was elected that this was a game changer. Those were my exact words. And there were several reasons for that. This is a businessman. He knows how to get cash moving back into the market. Not that this is necessarily real, because the environment is fake, but that's besides the point. So that's what people need to look at. It's pretty simple. 10-year yield below 3%, and longer term we need to be looking at, and I know a lot of people have a different perspective on this, but what I like to do is look at the spread between the 10-year and the 30. Why does Greg like to look at that? Well, everyone else wants to look at the 2 to 10 spread, or the 3-month to the 10. I mean, you got a lot of perspectives on this, because the 10 to 30 spread, the last 2 times this inverted, we ended up with a major problem. Dot-com bubble and the 2008 meltdown. I'm not looking for a recession here. That's when I was looking at the 2 to 10 spread inversion. I don't care. This is, that's just a normal market cycle, booms and busts like we were talking about, but we've never been here before. So talking about, to the second part of your question, I know I'm kind of dragging this out here, but if people can just get themselves on the right side of this trade, there's frankly an unbelievable amount of cash to be made. If you understand that the market is going to be propped up while they keep the 10-year yield in that sweet spot, continue to be long the market. Is the market going to gyrate? Is it going to move around because of volatility? Of course it is. Doesn't mean every single day the market's going to go up, but the trend will remain higher. So that's one way to capitalize on it. Now, going back to what I said here, what we're looking for here is an inversion of the yield curve, the 10-30 spread. And when that happens, that's going to be a forewarning that something is coming down the pike within the next, it's a lag. If history is any guide, the last 2 times this happened, there was a lag time, several months. So it's not like we're going to get an inversion, which I still believe we're going to. I think we have a 13-point spread right now between the 10 to 30 basis point spread. It was single digits just a couple of weeks ago, but they've managed to keep this balancing act going. And that's another issue they have moving forward. But that's what we need to be looking at. So once we do that, once we see that inversion, people should start thinking about maybe taking up short positions against the market. You can do this in a number of ways. The safest way, in my opinion, would be using credit spreads, but that's a whole other story as well.
Sure, and just a little clarification for listeners who want to understand why interest rates have such a profound effect on stock valuations. When the CPI numbers print at 2.9%, which means that inflation is eroding the purchasing power of the dollar at about 2.9%. Whether or not this is true or not, this is the official government print. When the 10-year bond yields around 3%, it means that the government is offering to borrow your money at basically zero. The real interest rates are zero, and therefore people choose, or governments or sovereign wealth funds or pension funds choose to go with stocks because the S&P 500 has a 2 or a 2.5% dividend yield, which is much more favorable than loaning the U.S. government money. As you increase interest rates, you create a situation where you can get real yield by lending money to the government, and you don't need to take stock market risk, which always has a balancing act for stock market valuation. This is why it's critical to view what Greg is talking about, which is the 10-year yield and bond yields in general, obviously coupled with inflation prices. Because if inflation rates rise along with bond yields, then you're really not making any progress by doing that, and that can create a situation where there's a bear market in stocks, a bear market in bonds, and investment dollars go elsewhere, which is obviously what the commodities bulls are hoping for. Greg, I want to ask you: do you view the established cryptocurrencies as a hedge against fiat currency crisis?
You know, I would like to think that's true. I do own this stuff. I own Bitcoin. I own Litecoin. I own Ethereum as well. I own a very small amount of Steam at this point. Here's the thing with regard to that. The number one thing I want to see Wall Street keep their hands off of this stuff. The deeper they start reaching into that sector, the more rigging we're going to see with regard to it. I mean, I don't think there's a person out here, anywhere you want to look, that explained to people exactly what would happen when Bitcoin futures started to trade better than me. I told everybody, I'm on public record with this, when those futures exchanges opened up, that we were going to see a dump. I told people to sell it. I told people to get out of it. I mean, I got laughed at and ridiculed on cryptocurrency websites and everything else. And you know what? I nailed it 100% correctly. So if Wall Street will keep their hands off of this stuff, I'm bullish here with regard to cryptos. But my fear is they're going to find a way to get in here and rig it and twist it. Look, here's the thing with cryptocurrencies. The entire market cap of cryptocurrencies, if you add them all together, is less than one S&P 500 company. So it's easy to get in there for a bank, let's say, for example, to get in there and run like a little pump and dump scheme and shake investors out of it. And I think there's going to be more of an effort for Wall Street here to tighten their grip on it. Why did they choose Bitcoin? Why did Wall Street choose to offer Bitcoin futures? Well, it's pretty simple, because Bitcoin is kind of the granddaddy of this whole thing. So by taking that one particular cryptocurrency and kind of putting a leash on it and pulling it wherever they want, they pull everything else with it. They're not stupid. They could have done this. They chose Bitcoin. So I don't know. Like I said, I am still a holder of mine. I will be holding mine probably for a long while. Believe me, I've thought of getting rid of my positions. My thing, what I feel like I'm good at, is trading equity derivatives. But I don't have such an overwhelming position in either of these that it's going to hurt me if they would even to go to zero. So, with that said, I would like to believe that these would be kind of a place to go in the event that let's put it this way, the debt market is allowed to do its job, and that is to determine fair value. Right now, we understand that's not happening.
Let's talk about the debt market. With the Social Security Trust, which owns more treasury debt than any other institution in the world, going into deficit for the first time ever this year and projected to be in deficit for the next 75 years, they will need to begin liquidating their holdings in order to pay the recipients. Then the Fed, as we know, which is the second largest buyer and holder of treasuries, they're selling as part of QT, as the quantitative tightening. And then you got China, the third largest holder, that doesn't need to buy any more debt because it's diversifying. It's not the same. It's not the same economy as it was 20 years ago and 15 years ago and 10 years ago when they were buying a lot of debt. They haven't increased their debt holdings. They've been letting it mature and just sticking to that $1.2 trillion level, but not increasing it. So we got a lot of pressure on the auctions because there are no new buyers. There are just new sellers right now. What's going on? Are borrowing costs for the United States government going to be way higher, or will they find a solution? How do you see this playing out? Because obviously, with tax cuts and with running giant deficits, there's got to be a balancing act sooner or later.
Of course, there is no solution. The solution is we're looking at it right now. We're looking at world central banks and other lenders of last resort. They're going to have to buy up everything. And look, everything. I don't care where you want to look in this market. Everything is not priced fairly everything. And the issue is, again, who's going to buy this stuff? Who's going to continue to buy? The debt-based economic model is a curse upon the earth. It's the truth here, and people just don't understand how it works. They don't understand that, again, like you were talking about with tax cuts and stuff. Where is this going to come from? Where's all this? Is it going to just be printed out of thin air? Sure, let's continue to do that and see how that plays out moving forward. It's an incredible situation that we are in, and I do not believe that there is a way out of this without having, don't listen to me on this. Listen to guys like Jamie Dimon, who just came out without major adverse things occurring across the spectrum of asset classes, including the debt market, including the stock market. I mean, look at, we've had guys like Alan Greenspan, other big Wall Street banks, all warning about issues in the debt market. And I've been talking about this, I think, before anybody else years ago. And, it's finally starting to come to a head here. And people don't understand that all of these programs, like we just talking about, are linked to the debt, which is in an unsustainable bubble. That's what it is. But people just, they're just whistling past the graveyard. They don't see it that way. They think people believe that the environment that we are in right now is in somehow real. It is not real. It's the same as if someone went out here and got a credit card with a $25,000 limit and was living off of it like a king for a month, and then all of a sudden that bill comes due. The bill's going to come due. And when that happens, how is it going to unfold? I think very, very disruptively, and it's going to affect all those kinds of social programs and everything else across the board. And unfortunately, I think a lot of people are going to suffer.
Well, I'll tell you what, I have talked about this since 2012, that by 2022, the United States middle class will be all but gone. There will be 10%. There will be 10% of the people that are in the upper class, 90% of the people in the lower class, just like any modern country outside of the U.S., which had this artificial middle class because of the post-World War II boom. And this is the time, this is the last 3 years to make whatever you can happen in your life, whether it be by business, by investments, by relocating. You need to figure out how to build a financial fortress right now, because there will be no middle class in America by 2022. Just won't be. And I want to ask you, in light of this, whether obviously only if you agree with me that the United States middle class is going to evaporate, what do you think Americans should do to replace the depleting purchasing power, and where can they find high-paying jobs or higher-paying jobs within the United States? Where are the states that are going to boom? Which jobs can be dependent upon in the next 10 years? And what do you think overall in terms of this demographic group, the millennials, which are becoming the largest in numbers?
First of all, I agree with you 100%. We've been watching the middle class be decimated. It's going to continue. I've been saying that we are going back to a feudal system for a very long time. Of course, people don't want to hear about that. They think they think where we're at is sustainable, of course. But that's just simply not the case. So I think you got that absolutely right. And it is very sad. I think people have to come to understand that within a very short period of time, I don't know when that is. I don't like putting timelines on things anymore. Because all this has gone on way longer than I think most people would have believed. But I also think, and this includes myself too, I never would have realized the lengths that I wasn't capable of it at the time, understanding the lengths that central banks would go through. I mean, we're talking about not just QE1, and then we had QE2, and they have Operation Twist, and they have all kinds of backdoor bond buying going on here, of central banks buying each other's debt. This is something that's not talked about, but this is going on as well. There's all kinds of stuff going on under the table here. But what people need to understand, and it plays right into what you said, and again, I agree, is we have to get used to a much different way of life coming down the pike. And when this corrects to fair value, the whole market and everything in it is when we're going to start to see that. And I think it's going to be very rapid, and people are going to be absolutely not prepared. But that's part of the plan too, in my view. How have the small amounts of people been able to control the masses since the beginning of time? Well, by doing this kind of thing. Number one, here in the United States, keeping people divided by any means necessary, by race, by religion, by age, by whatever they got to do. Keep people divided, divide and conquer. That's their strategy, and it always works. It never fails. People fall right into it like they get puppetized. Anyway, so what can they do moving forward here? Understand that the environment. If you just understand that the environment we're in is not sustainable, and you start taking action now. And I've been saying this since forever. Become your own central bank. Bet against the debt. I understand and understand that the rigging, and that's what it is, with regard to precious metal prices here. And again, these are not trades; these are down the line. I think people need to allocate a percentage of their portfolio. How much? I don't know. 10% sounds like a good number to me. Or more. It depends on your wealth or on your situation here. Start acquiring this stuff. If you're going to acquire just one, it would be silver for me, just because it's not only a monetary metal and has been so for thousands and thousands of years, but it's also an industrial metal and a medical has medical uses as well. So that would be where I would think people need to be looking at. But with regard to jobs and stuff. That's a really good question. I think people need to. Where would I even look at? I think we're going to need technology moving forward, no doubt about that. I think tech would be a good thing to be looking into. Learn to make things. Learn to create things. Don't understand that by going to, let's say, a 4-year college and walking out of there with a bachelor's degree in whatever, more than likely it's useless to you. And we need to turn things around. We need a society that builds things, that makes things. And I've been saying that for years as well. And I don't think that's sunk in. People still believe that they need to go to a school, get some degree in something. If you want to go on to a nursing degree or a medical degree or something, well, that's a whole different story. But going to college here and coming out with a degree in uselessness, pretty much, isn't gonna really bring you too much moving forward. You got to learn to create. You got to learn to make things. Maybe. Something along those lines.
Greg, thank you very much. That was a funny one. Let me ask you finally, where can people check out your work? Where can people follow you? I know you have a very vibrant YouTube channel. Can you share with everyone where they can check out your work?
Sure. Just go to my website, traderschoice.net. Everything on there you want to find out, even that free stuff for you. Go take advantage of it, and I'll see you guys over there.
Perfect. Greg, thank you very much for taking the time today, and we'll definitely have you on again.
Thank you. I'd like to be here again.